Welcome back to another video, guys. It is Investor Andre, and we got a beat up stock for you guys right now. CSIQ, it's a solar energy company. They're down 15% today. They're selling at the same prices they were in 2017, and it is looking pretty dirt cheap. If you look at the statistics, they're trading at a 5 price to earnings, 0.14 times sales, and 0.38 times book value. Now, this company does have almost $2 billion in cash, but it has $4.2 billion in debt. There's a lot of things going on with the company. They did just release earnings that we're going to go over, and there's some shady stuff going on with the company. But overall, it is looking pretty cheap, and the company is not very shareholder friendly. But let's look at some of the things that are going on. So one big thing that I'm excited about is there's a China IPO happening within a few weeks, approved just this morning. This was in March 2023, so it still did not happen. So we'll see how that goes. They already have the cash for the 2023 capex. The new cash could have further accelerate capacity. Margins are currently 17%, are supposed to go to 20-30% soon. Module prices are down a bit, but much less than the decline in cost, so margins should still grow. And China IPO thing, they've been working since Q3 2020, so that has been in the making for a long time. And we can see this comment as well. From an article, it says Canadian solar is dirt cheap despite having the best returns in its peer group, best performance in the last decade between solar companies, blah, 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 blah. And they're down 15% just today. So this could be a great opportunity to get in. One thing that I'd like to point out is the CEO and his wife together. The wife is also as part of the management, and together they own 25% of the company now, not 23%. And at $18 a share, they did put up an offering to buy all the outstanding shares they do not currently own. Now, so we can see the CEO and the management is pretty greedy, and we can see that in the last quarter, stock-based compensation as percent of cash flow was 41%. So 41% of the free cash flow went back to the management. That's not a very good thing to see at all. And if we can see is the company has been growing a lot. And since 2017, if you look at it compared to the 2017 revenues, the revenues have been growing insanely. But the one thing that hasn't been growing is we can see revenues were less than $1 billion. Now they're at $1.7 billion. And this is quarterly revenue as well. And the market cap is under $1 billion. But the net profits have not been going up. And this company is expanding a lot and is growing a lot. We can see in some of the news, there's a $200 million private placement for secured convertible notes. So they're raising some money, $200 million. We can also see that they're building a storage project in southeastern Australia. They have a 50 million euro facility from the European Investment Bank. What else do they have? They have a bunch of things going on. And then if you look at the last quarter, we can see just in the last quarter for 6 months ended 2024, they have $3 billion in net revenues compared to $3.7 billion. Income from operations, $175 million compared to $288 million. So again, gross margin is 17%, but it's not looking too good. And if you want to see something that's not looking very good, let's look at this. So this is the recurrent energy segment. 6 months ended 2024, not short of 90 million in revenues compared to $380 million. And net income of negative 29 million compared to 100 million. So it is not looking very good at all. But if you look at overall some of the things that has been happening, and we can see that they are still, along with the guidance, net revenues of 1.6 million, guidance is 1.5 to 1.7, shipments 8.2 gigawatts, even above the guidance. We can see that the gross margin is 17%, in line with the guidance of 16 to 18%. So scratch that comment that said growth to 20 to 30% margins. It's looking more like 16 to 18. It looks like it's going to stay here for a while. A big thing, BlackRock. We can see BlackRock's investment in recurrent energy representing the majority of the planned 500 million capital infusion. That's a big one. We already went over the 200 million convertible notes, and we can see that let's see some of the things they said that they achieved solid results in second quarter 2024. Yes, they did. Everything is in line. We can see here, despite the challenging market dynamics, CSI Solar achieved strong results in first half. And this is the CSI, the Chinese company. So I guess they did do the Chinese IPO. I got that wrong. And we can see that they are maintained and focused on profitability, which is what they're missing because they're growing like crazy. They're expanding, investing a bunch of projects, but the profitability just is not there. Now, let's look at some of the financials. Like we did mention before, they have, I think, $1.9 billion in cash. They do have a pretty clean balance sheet. They have 16% in cash, no intangible assets, and they do have a good amount of debt. Now, this is a growth stock, so they are investing a lot into the growth. We're going to get into the valuation in a second. But if you look at the insider trading, no insider transactions that we can see right here, and even the institutional trading, you can see Nobody has bought or sold this company since 2020. So it has been pretty dead. Right here, it says the CEO owns 17%. So this wife, it is closer to 25%. So a lot of insider ownership, but the insiders do not look very shareholder friendly. They tried it before and they might try it again. They tried to buy out the company at $18 US a share. Now it's trading at $12 Canadian a share. And they're doing a lot of stock-based compensation. They're not doing dividends. Instead of giving us, the shareholders, money back, they're taking the money for themselves. We can right here, if you look at Moomoo, what Moomoo's thinking, it has a price target of $23, fair value of 25, which is a double from the current price. Price to book of 0.3. We can see the revenue breakdown. And then we can see the revenue, how the revenue has been going. So the last quarter, Q2 2024, they did beat the estimates. But if we look at the earnings per share, which is the important metric because we want this company to get more profitable, they missed it. And on guidance, it's supposed to go way more down next quarter. And then Q4 2024, it's supposed to go back up to higher than where it is right now. So this company needs to get their things together. They need to get more profitable. And currently, I do not own any stock of the company. And if they do get their net margins up, I will consider investing in the company. It is selling dirt cheap right now. Here it says PE of 24. It is more of a 5 price to earnings, 0.1 price to sales. Looking pretty cheap, guys. So yeah, let me know what you guys think about the company. Do you guys hold any shares? Are you guys bullish on it? Do you guys want an in-depth video on it? Let me know. I just wanted to get the company on your guys' radar because it is down bad and it is looking cheap. And also has the AI to do a little market analysis. And we can see that the analysts, 2 buy ratings, 1 hold, and 3 sell ratings. So the analysts aren't too bullish on the company. Valuations is pretty cheap. Have a $4 billion in debt, $2 billion in cash. Market cap of 873 million. So they have a very small market cap. They're selling pretty cheap. Earnings growth forecasted to grow at an annual rate of 18%. Now, if this happens, this would be amazing. This would be outstanding because that's what they're missing, the earnings growth. Not just the revenue growth, but the earnings growth. And then we can see the sale forecast, 1.5 billion with a range of 1.4 to 1.7 billion. So currently they are in that range. And then I asked them, what are some of the key factors driving the CSIQ stock performance? Because they have been going down. And one thing that we can find, or we can read through a couple. But yeah, the main thing is just the earnings are down. They're focusing on expanding its e-storage business because that is one of the big things growing and that's trending in the industry is the energy storage. And solar panels have been around for a while. They did go through the hype already in 2021, especially. This reached almost $60 a share, trading at $12 now. And if you look at the analysis, let's see what the analysis is saying. Wow, it is projecting the revenue to go up to 9 billion for full year 2025. That's a 20% gain. And if you look at the earnings, it's expected to go 2,000% up at 19 cents a share. I'd like to see that. That is the biggest miss they had. Look at this intrinsic value of $120. That is a 10x from the current price. It's currently selling at $12. Where is it? I really want to show you. Oh, there it is. Okay, finally. So earnings per share of 2 cents fell short of an anticipated 13 cents. So that is why the stock is so down because they really missed out on the earnings. The earnings are very down and this company is barely staying profitable. And yeah, the main thing is 2 downsides. The management I do not like. And the second one is they're not very profitable. They are growing the revenue all right, but the profitability is not there. Let me know what you guys think. Do you guys own the stock? What stocks are you guys buying? Let me know down in the comment section below, and I'll see you in the next one. Peace.